Hello and welcome to another episode of Co-Founder Chats. My name is Ryan Correa, co-founder and managing director at Equivesto. I'm joined by my fellow co-founder and subject matter expert, Alexander Morsink. And
Hello.
today we'll be talking about private investing. Getting right into it, Alex, what is private investing?
So private investing is essentially buying a piece of a company that is not a public company. Public company is a company listed on a stock market or a fund that's available on the stock market. Private investing means you're buying into a company that is not yet listed. And so it's going to come with many changes, and the experience is going to be different than investing in a public company.
What is private investing on Equivesto specifically?
Private investing on Equivesto comes with a bunch of benefits, and the process is a little bit different than if you were making a private investment entirely on your own. If you're investing entirely on your own, you'd have to go and research the investment by yourself. You'd have to verify the information being presented to you however you so chose. And then you would have to sign the investment documents directly with the company and find a way to send them the funds on your own. By using Equivesto, a licensed exempt market dealer and online investment portal, you're able to know Equivesto has completed its know your product process, its due diligence process into the company to verify the information they're putting in front of you first. Of course, Equivesto has also done suitability, KYC, and eligibility assessment on you, the investor. And then you're able to actually review all of that information in one digital location, sign your documents digitally and have a location where they're stored forever. And then, of course, move the funds digitally. And the Equivesto platform becomes that location where you can find a record of all the investments you've made through the platform in one location.
So if I've made an investment, what happens next?
Right. This is a very detailed question, but let's start with looking at what you might normally be used to making a public investment. If you're used to investing via the stock market, public investments are required to prepare audited financial statements annually, as well as prepare reporting on a quarterly basis. They're also open and available for trading, meaning investors can buy and sell those investments whenever the market is open. These two factors together create an environment where you're able to look at your investments in real time and see their current value. You're also able to go into the platform and choose to sell those investments whenever you like or go and buy new ones. If we're talking about mutual funds or other investments like that, you would work with a financial advisor to buy or sell them. But other funds like ETFs or stocks or bonds that you own directly, you can buy or sell through a self-directed trading account anytime you like. You're also seeing the market around you do research in real time into these companies, comparing them with others in the industry, and people are buying and selling based on that. So the prices of these public investments are just through the nature of people buying and selling, essentially right sizing themselves, hopefully, based on all publicly available information. So you, as a passive investor, actually benefit from everyone else in the market participating. Now, if we flip that to the private side, because private investments do not have continuous reporting requirements that involve audits and things like that, and because they're not able to be traded freely and openly at any time, you lose out on a few of those features. For example, you're not going to see the value of your investment fluctuate up and down every day. With private investments, like with any investment, the actual value of the investment only changes when somebody agrees on a price and transacts based on that. In the public market, people are agreeing on a price and transacting all the time. So the value of your investment is moving up and down, up and down, up and down based on that agreement of price and that transaction. In the private market, the company or the fund raised money when you participated, they might not raise money again for 5 or 7 years. Even though the business continues to do well, that is not going to trigger a updated valuation. And even if they provided an estimated or a target valuation, no valuation is set legally until somebody transacts at that price. What that means for you is, as an investor, you might make an investment in something and not see the price or the value of your investment move for 3 or 5 years. It would stay the exact same price that you bought it. It's not going to adjust until that moment when somebody else invests in or sells their investment. Another thing to keep in mind is the availability of all of that information and reporting. So that information, all that reporting stuff, when you're making a public investment, that's all being automatically disseminated to all investors. So you're getting access to that either through the company's website, but you're being notified about it even through your trading platform. With private investments, certainly through private investments made on Equivesto, Equivesto as a platform is a transaction location. So you're coming to Equivesto to get information on the company when the company is available for investment and when you're making your transaction. After that transaction is over, then all communication, all relationship management, all updates, all changes in value, that information is going to be communicated directly to you by the company. And the Equivesto portal will not be updated with that information. The Equivesto portal is not a location to check the current value of your investments. All of that information, if there are changes in value or any other updates, will come directly from the company, and you can use the contact information on the Equivesto website to reach out to the company if you haven't been receiving any of those updates. But you're not going to log into Equivesto and suddenly see the shares of the company you invested in are now worth twice as much. Equivesto is purely a transaction record, not a what is the current status of my investments. All of that will be communicated to you directly by the company after the investments have taken place. So with this in mind, you can see the private investing landscape is quite different than the public one. You're not getting real-time updates on the value of the investment, and you're not getting all the information and updates presented to you in one location. Equivesto is here to give you that information when you're doing the transaction and a clear record of all of those investments that you have made. But each company in the future after the transaction is responsible for communicating with you about that directly.
What is the post-investment difference between public and private investing?
Public investments, you're able to see updates all the time in real time about the value of your investment, and you're able to get all of that information in one place, typically through your self-directed trading account. So you can log in, see the current value of your portfolio, and decide if you want to buy or sell anything new. In the private investing space, all of those updates will come directly from the company. Also, private companies don't go and raise capital all the time. And so the value of your investment or the price of the company itself, even if it's targeted to have gone up, the physical price, which only changes when a transaction takes place, is not going to change that frequently. And so you may have months or years, maybe 5, even 7 years, where the price of your investment might never change. That doesn't mean that the company's not achieving things or reaching their goals or growing. It means that nobody else has been given the opportunity to invest into the company since then. And so that price has not officially changed. And that will only change when there is potentially another large investment in the future or a large exit, which you would then have to participate in. Another big difference between public and private companies is when can you sell? How are you able to get out? The simple answer is for private companies, unless there's specific things that take place, you are not able to get out. You're not able to leave your investment generally. In the public markets, people are able to buy or sell their investments anytime. For private investments, you are locked in unless something specific occurs. So it's essentially either one, the company itself is entirely bought by somebody else, and so your shares is bought as part of that. The other option is if the company goes public. So then they list themselves on a stock market, and then all investors are able to trade their shares, including you. The final option is if the company does a share buyback or allows investors to sell their shares back to the company. This is, again, not typically or necessarily allowed. You would need to read the terms of your shareholders agreement or limited partnership agreement to determine if this is allowed to happen and what the instances are when this can occur, because this isn't typically allowed in all scenarios. Many mutual fund trusts that are structured through an offering memorandum do have required redemption clauses. However, they typically have additional fees that make it not worthwhile necessarily to redeem unless absolutely necessary before a certain amount of time has passed. So you should read those offering memorandums and limited partnership agreements for full details on if they have a redemption clause and how that might work.
Post-investment, what kind of updates should I expect to receive from the company, and who is responsible?
When you're investing in a public company, the updates on the company typically are coming straight to your trading platform, and you can review and see them there, or a quick Google search will show you all the press releases that the company's done and take you to their website so you can see all those updates. With private investing, once the investment has been taken place, all of those updates, all of that information is now the responsibility of the company, and they should be communicating that to you directly via email. We typically recommend companies send out investor updates once a quarter. They are legally required to update you and invite you to a shareholders meeting at least once a year. So you should be looking for those information and those updates directly from the company themselves. Equivesto as a platform is a transaction-focused platform. So this is a record of all of the transactions you've made and the documents associated with those transactions. It's not a ongoing update location. The company can choose to use Equivesto for that purpose, but the vast majority of them will be providing updates directly to you via email. Equivesto is not responsible for ensuring those updates are getting to you, but if you haven't received them, we're happy to help problem solve that for you.
Where can I view my investment progress? Is it on my Equivesto dashboard?
Exactly. So in terms of the investment you have made, the Equivesto dashboard will show you the transaction details of all the transactions you've made through Equivesto. But in terms of any increases in value or any updates or changes to the company, that won't most likely be available in the Equivesto dashboard. That information should be coming to you directly via email from the companies.
What are the tax implications of private investing?
It's a great question. And now, this is not official tax advice. Please speak to your own tax professional or lawyer regarding any tax details specifically for you. In general, taxation on investments work in a few different ways depending on the way or the type of money being returned to you. There's capital gains, which is if your investment goes up in value. There's a return of capital, which is a situation where you made an investment and they're returning some of those investment funds to you. There is dividend income and there's interest income. Dividend income is when the company pays a dividend or does a distribution of the profits in a structured way that's not part of a return of your funds or an increase in the value of the investment. And the interest income is money that's earned from an interest rate on a debt that you hold to the company or investment. Now, from a taxation perspective, return of capital is not taxed. What is taxed is capital gains, which is any gain on the investment value you originally made. Now, capital gains in Canada is taxed based on an inclusion rate. So not all of the capital gains are taxed. Just as a comparison, on your income, all of your income is taxed. So the inclusion rate, the amount of your income that is included as being taxable, is 100%. You do not have 100% tax on your income, but you have an inclusion rate of 100%. So if you have 75,000 in annual income, all 75,000 of that is taxable. For capital gains, the inclusion rate for capital gains up to $250,000 is 50%. That's not a tax rate of 50%. The amount of capital gains that is taxed is 50%. That capital gains that is taxed, so 50% of the value of the capital gain, that amount is taxed at your marginal tax rate, whatever that is for you personally. So, for example, if you bought something and it grew in value considerably and you sold it for $50,000 more than you initially paid for it, so the company went up, your investment went up by $50,000 and then you sold it and exited, the overall capital gain is $50,000. However, because of the inclusion rate of 50%, only $25,000 of that is being taxed. The tax is not 50%. It's not you're being taxed on 50% of the money you made. It's that the tax is being calculated on only 50% of the money you made. So again, if you made $50,000, only $25,000 of it is having tax calculated on it. So you take that 25,000 that's included in the capital gain, and then you're going to apply your personal marginal tax rate to that. So you could say, okay, it's 38% or whatever it is, depending on your personal situation, your income, your province, all of that's going to impact your marginal tax rate. So you will probably end up being taxed, somewhere between 30 and 40% on the amount of the capital gains that are included in being taxed. So if that's $25,000 being included, you're going to be taxed on, let's call it $10,000 to $12,000 of that. So if the overall capital gain is 50, you're only paying between $10,000 and $12,000 of that in capital gains tax. Now, it's important to note that the tax inclusion rate on capital gains has recently gone up for capital gains over $250,000. So if you made $250,000 worth of capital gains, the inclusion rate, again, the percent that is being included in the tax calculation is 50%. But once you pass that, any amount beyond 250 is now being taxed at a 60% inclusion rate. The tax rate being applied is still your marginal tax rate, but the amount of the capital gain that is now having tax applied to it is 60%. So that is a brief rundown of the capital gains portion. The dividend taxation is slightly different. There are certain dividends that are standard dividends and basically included in the taxation rate, and there are certain dividends that are excluded. It's a little bit more complicated, but at the end of the day, it roughly comes out to that sort of same 50% of the value is being taxed. And then from that 50%, you then apply your marginal tax rate. It ends up coming out to something roughly similar, but it is a bit more complicated. So please speak to your tax professional about that. But that kind of summarizes how the taxation portion is being handled of the income that you're being earned from your investments. Now, let's talk about when that tax is actually being applied. So the capital gains tax is only being applied when you sell your investment and if it's gone up in value. So if you buy a private investment and you don't sell it for 10 or 15 years, you're not going to be paying any capital gains until it's sold 10 or 15 years from now. Whereas a dividend income tax, that tax is being calculated every time you receive that dividend. So for example, if a company is paying you a dividend on an annual basis, they need to be preparing a tax form for you each year and sending that to you. And you need to include that within your tax filing. If they're not sending you that tax form and you're receiving a dividend from them, you should please follow up with them and request the tax form for any dividend income you've received. Now, if you've made your investment via registered funds, of course, then those are not being taxed in the same way. If it's via a TFSA, it's tax free. So then you're not being taxed whatsoever. If it's an RRSP, then the tax is only being applied when you're withdrawing the funds from the RRSP, which would be at a later date.
How do I know the current value of my private investment?
Knowing the current value of your private investment is going to be honest, quite challenging. You're only going to be able to determine the valuation if the company is currently transacting and has set a price for their current transaction. That is the closest you're going to get to being able to say, this is the value of my investment right now. Because the value of private investments only change when a transaction takes place. The value of any investment actually only changes when a transaction takes place. In the public markets, transactions are happening all the time, so you see real-time value changes. In the private markets, the value is only changing when a transaction takes place, and transactions happen very infrequently, usually in a controlled manner. So companies might raise capital only once every 1.5 to 3 years, or maybe even less, depending on their goals and objectives. So for you as an investor, you're not going to see any value changes in the company very frequently whatsoever. Also, just because there was a transaction at a certain price doesn't mean future transactions will be at the same price or a higher price. The future transaction, the one that you participate in to exit, could be at a lower price depending on business environment situations, the industry changes, global macroeconomic environment. All of that could impact the actual value of the transaction when you participate in it. So if you want to be able to just have a rough idea yourself, what you'll need to do is look at the information presented to you when you invested and compare that to the most recent company updates and internally prepared financial statements from the company that you have access to. And you'll have to look at those and get a rough idea of whether you think the company is doing better or worse than when you invested. You can always consider asking the management of the company directly, hey, do you have a rough valuation that you're targeting or that you believe the company is at? But again, this provides no guarantee that when you yourself participate in a transaction to exit the investment, that will be the price that you get as well. It's not a straight linear increase. Typically for private investments that are locked in a private company, you would make your investment and you might not see any change in the value of your investment for 5 or even 7 years. And then suddenly it could jump a whole ton if the company has done really well, and then you have an exit at that time. But other than the updates from the company, you're not getting any information that can help you determine if the valuation has gone up or down.
When is my exit or return expected?
Private investments are not available to be traded freely anytime. And so when you as an investor are allowed to exit is essentially quite limited. The baseline rule for the vast majority of situations is never. There is no specific set moment where you're allowed to sell your investment. It depends on a number of factors associated with the company and terms of your specific deal. But a good rule of thumb is you're never allowed to sell your investment. So you need to keep that in mind when making the investment in the first place. Now, there are three situations where investors might be able to actually sell and exit their investment. The first is if the company goes public and lists itself on a stock market. Then you, as an investor, like all other investors, will be able to buy or sell your shares. The other option is if the company itself is being bought. That's different than the company receiving investment. The company is receiving further investment. The company is making more shares out of the company and selling those shares directly to new investors. If the company is being bought, some other third party is buying all of the shares held by the existing investors and compiling them all into shares now just owned by this third party. If the company is being bought, your shares would be bought as part of that, and there would probably be a company vote, which you as a shareholder would be invited to to see whether or not they were going to proceed with selling the company to this third party. The final way that you can potentially exit your investment is if the company or fund specifically has a buyback or redemption clause, where the company or fund agrees to buy back the existing shares from investors if certain conditions are met. Not all companies offer anything like this. Certain types of private funds, so typically mutual fund trusts, do have to offer redemption clauses, but they can come with high fees for redemptions before a certain period. Now, you can make money from your investment through dividends, which any of the above companies we've talked about can offer to you, but that doesn't mean you're able to actually exit or sell your investment. So essentially, when are you going to be able to exit? Assume never, but you will be able to exit if the company is bought, if they go public, or if the company itself allows for a stock buyback or some sort of redemption clause where you can sell your shares back to the company directly.
Who is the custodian of the investment?
So when you make a public investment and you're investing via a bank, typically the bank is being something called a custodian. So you make that private investment and the company issues you a physical document that represents your proof of ownership. And the bank has an entity that it owns, which is a custodian that physically holds on to that proof of ownership for you. And so if you want to change who is the beneficiary, or you want to transfer that ownership to a member of your family, or you want to sell it or something, you have to speak to the custodian because they're physically holding your proof of ownership. For private investments, this is not the case. Most private investments, they don't offer physical documents of ownership, and the record of you being an investor is maintained in something called the shareholders register, which the company themselves maintain. So the proof of ownership is all of your investment documents and the shareholders register that the company itself is holding on to. What that means is if you want to transfer the ownership or exit or do anything like that, the person you need to talk to is the company itself. So they can confirm if that's allowed and then update their shareholders register with that new information. Equivesto is the transaction location. So we have the documents of record showing you made the transaction, and you can use those as proof of your investment and proof that you are a shareholder. But Equivesto does not need to be updated far into the future if you're planning on selling or transferring your shares. Now, if you've invested via registered funds through a trust company like Olympia Trust, in those situations, Olympia Trust is the custodian. They're managing your TFSA RSP for you, and they physically have the documents from the company showing the proof of ownership. So you would need to communicate with Olympia Trust directly about any changes in beneficial ownership or things like that. Of course, this would also have an impact potentially on if you're using registered funds, because how you transfer registered funds typically means they have to exit their protected registered account. There will be tax applied, and then they can be moved afterwards.
Who is the beneficiary of my private investments and Equivesto account?
So the beneficiary of your private investments is typically whichever person you have included in your will, or whoever would be chosen by your estate after your passing. Equivesto is not holding the ownership of any of the companies that you've invested in on an ongoing basis. So Equivesto is not the master record location for that. So you wouldn't need to necessarily contact Equivesto if you wanted to change the beneficiary of any of the investments you made. It is going to be either the company itself if you invested directly in cash, or Olympia Trust or another trust company like Western Pacific Trust if you had invested via registered funds like TFSA RSP. So you would contact either the company themselves or the holder of your TFSA RSP if you wanted to change your listed beneficiary.
Broad question. How do I set myself up for success in private investing?
It's a good question, but it's essentially the $1 million question. Really, private investing, it's important to keep in mind that while it is high risk, there is potential for higher returns. And so when you're making your investments, you want to be keeping that in mind. You're not going to be making, you know, and putting, let's say, 90% of your net financial assets into private investments. That's highly unadvisable. You want to put a portion of your overall portfolio into private investments so you can take on a little bit more risk, but also benefit from potential increased returns. That being said, when making an investment, you want to focus on diversifying across your whole portfolio. Choosing private investments is a form of diversification from public investments. A lot of public investments, the value of them can change month to month based on overall market opinion or other information beyond your control, where private investments, as we've just talked about today, are not going to have huge valuation swings purely based on those factors. When the company is going and having a price change, it's typically a controlled event where different groups are agreeing on a price to cause a transaction to take place. It's thought out and heavily involved. So that itself is a form of diversification. You also want to think about diversifying across multiple different industries and verticals. You don't want to put all of your money into high tech, business to business, software as a service startups in one single industry, because if that industry has a problem, you would be heavily negatively affected. You want to consider diversifying your investments across as many different industries as you can. Of course, having some knowledge about these industries beforehand can help you pick your investments and feel more comfortable in them. So we recommend doing research into any industry you're thinking about investing into, and of course, reviewing all of the different information made available by the company on Equivesto itself. Finally, we would recommend starting small. You don't have to go out and make a $50,000 or $100,000 private investment right out the gate. The whole purpose of Equivesto is to allow and create opportunity for more people to access the private markets and be able to do so at smaller investment amounts so you can choose the right amount that makes sense for you because it is higher risk, higher return. One of the big challenges of private investing for a long time is the minimum investments were so high. And so even if you qualified to access a private investment, you didn't necessarily want to put up $250,000 or $300,000 to invest in one of these private funds, 15 or 20 years ago. Even our higher minimum investments typically have a minimum investment of $50,000, which is compared to historical norms, much lower a minimum investment required. But we always have options available in the sub 10,000 and often sub 5,000 minimum investment because we want to let people take smaller bites and try things out while they're getting more comfortable with the space. But again, because these are private investments, you're not going to see a return potentially on some of your investments for 5 to 7 years. So this is a situation where you won't be able to wait until you get those returns to decide if you want to keep making other investments. That's why we recommend diversification, doing your research, and planning out your overall portfolio so that you're not overexposing yourself to any one category of investment.
Hey, thank you, Alex. That was pretty much it.
Thanks, Ryan. We're here to help you navigate this space, and we know it can be a little bit confusing. We're doing our best to make it a little bit more accessible and a bit more straightforward. If you have more questions about how to set up your portfolio or the process of making an investment, please feel free to reach out to Equivesto. You can reach out at support@equivesto.com, or you can hit us up in the help chat on the website directly. Thank you.